Welcome to Economy Roast, the show for sharp, in-depth economic analysis featuring world-class experts. If you're looking for a clear and objective perspective, you're in the right place. Let's dive deep into today's topic.
Just hours before reciprocal tariffs of 125% and 145% were set to take effect, the U.S. and China reached an agreement to extend the tariff deadline to November 10, 2025, granting an additional 90 days for negotiations. Accordingly, the U.S. will maintain its 30% import tariff on Chinese goods, while China will keep its 10% tariff on U.S. goods. This move prevents Chinese goods from facing higher tariffs as U.S. retailers prepare for the critical year-end shopping season. The White House stated in a press release that the tariff agreement extension will provide additional time for negotiations to address trade imbalances and unfair trade practices. The statement noted that the talks will also aim to enhance market access for U.S. exporters in China and address national security and economic concerns. In return, China urged the U.S. to lift unreasonable trade restrictions, cooperate to benefit companies on both sides, and maintain the stability of global semiconductor production. Chinese stocks rose while Hong Kong shares remained steady on Tuesday, August 12th, as the extension of the tariff truce between the United States and China, the world's two largest economies, helped ease investor sentiment. On Monday, August 11th, Washington and Beijing extended the tariff truce by 90 days, temporarily halting triple-digit tariffs on Chinese goods, a move that was largely in line with market expectations. Chinese markets have been trending higher in recent weeks, as investors welcomed positive signals from U.S.-China trade talks in Geneva, London, and Stockholm, which have focused on reducing retaliatory tariffs from triple-digit levels. Beijing residents expressed hope for reduced confrontation and greater openness and cooperation between the United States and China.
I don't think either China or the United States wants to see their relationship continue to deteriorate. If both sides raise tariffs, it will have a pretty negative impact on business cooperation and the economy for both countries. That's why both are taking the current approach, but the game and confrontation may not be over yet, so there's still risk.
I think that in a trend toward a globalized economy, countries' economic policies and the trade of goods are all closely linked. We should really adopt a mindset of mutual benefit and win-win cooperation.
I believe trade is very important because China and the United States are the two most important economies in the world. Trade barriers and similar international policies, like those in the U.S., are totally unacceptable in a globalized environment. I think we should adopt the approach China has, being open and inclusive, embracing diversity, so that we can drive growth not just domestically, but also in surrounding countries.
However, according to some analysts, the agreement between China and the United States to extend tariffs is not actually a noteworthy step forward. On the contrary, it reflects the negotiators' impotence and deadlock.
When you look at how the U.S. has approached with making a lot of these threats, the challenge is that the shock value of these threats continue to diminish every time a threat comes, but it isn't executed upon. So what you really need for credibility is that you have to have some clear plan, some enforceability along that discussion path as well. But of course, we can't underestimate the U.S.'s ability to continue to add more shock value in more threats going forward. So I suspect the type of leverage the U.S. has, certainly as the largest consumer market in the world, will continue to be a factor that'll cause other countries to think cautiously. My guess is we'll continue to have an extension going forward, at least until Xi and Trump have a way to meet each other one-on-one. But even after that, after they've set the tone that negotiation is still in the cards, we'll probably continue to see different levels of extension, maybe by sector, maybe by tariff categories and so forth. But the negotiation will continue extensively because the issues are so complex. As we're looking at a more volatile trade environment right now, the reshoring, the supply chain diversification will continue onwards, but it may not accelerate as fast as it used to be, primarily because the multinationals that have already diversified their supply chain probably will not need to continue to do so. I think what we may see, which is actually against the trend, is that we might start seeing some more reshoring back to China. Generally, when you're looking at reshoring, ideally you're going to be closer to where your target customer market is. But if you're looking at it purely from a cost standpoint, looking at it from the ability to create new products rapidly at a cheaper cost, then the appeal of China is going to start looking stronger over time in a world where every country is facing higher and higher tariffs and greater uncertainty.
In reality, the conflicting issues between the world's two largest superpowers are far too complex, ranging from geopolitics and global influence to their roles in current international flashpoints, all of which affect the likelihood that both sides can put pen to paper on a sustainable trade commitment. Even if such an agreement were to materialize, it would remain fragile and highly susceptible to being undone by an environment rife with both direct and indirect conflicts. Even with the tariff extension in place, trade flows between the two countries have been heavily affected this year, with U.S. government data showing that imports of Chinese goods into the United States in June 2025 dropped by nearly half compared to the same period last year.
The two sides are still discussing issues including access to China's rare earth resources, China's purchase of Russian oil, and U.S. restrictions on selling advanced technology, including chips, to China. Recently, Mr. Trump eased some export restrictions on technology products, allowing companies such as AMD and NVIDIA to continue selling certain types of chips to firms in China in exchange for sharing 15% of their revenue with the government.
If law enforcement officers encounter a criminal...
The White House said on Tuesday, August 12th, that agreements could potentially be extended to other chip companies after NVIDIA and Advanced Micro Devices agreed to give the U.S. government 15% of the revenue from sales of certain advanced chips to China.
Is this something the administration is looking to do with other either chips or products, going forward? Is this a model it wants to build on?
Well, look, right now it stands with these two companies. Perhaps it could expand in the future to other companies. I think it's a creative idea and solution. The legality of it, the mechanics of it is still being ironed out by the Department of Commerce, and I would defer you to them for any further details on how it will actually be implemented. But again, this was another idea of the president and his brain trust on his trade team to try to, get good deals for the American people and the American taxpayer.
According to data from the U.S. Department of Commerce, imports from China surged earlier this year in an effort to avoid President Trump's tariffs. However, this activity dropped sharply in June. The U.S. trade deficit with China fell by more than 30% in June to $9.5 billion, the lowest in over 20 years, down 70% compared to the same period last year. American manufacturers are particularly concerned about the possibility of China restricting exports of critical minerals and magnets. Data shows that goods from China to the U.S. dropped 21% in April compared to a year earlier, while the country's exports to Southeast Asian nations rose by 21%. This indicates that China is seeking alternative channels to keep its export engine running.
In Southeast Asia, President Trump has imposed a range of reciprocal tariffs, from as low as 10% in Singapore to as high as 40% in Myanmar and Laos. Cambodia, Indonesia, Malaysia, Thailand, and the Philippines face a 19% tariff, while Vietnam's tariff rate has been set at 20%. Alongside this move, Washington has also warned of secondary tariffs, pressuring Beijing to halt its purchases of Russian oil. Late last week, Mr. Trump further urged China to quadruple its purchases of U.S. soybeans to help reduce the trade deficit.
These are the latest updates we wanted to share with you. Thank you for watching Economy Roast. Don't forget to like and subscribe so you won't miss our upcoming analysis.